My name is Brian Caplen. I'm editor of The Banker. To my immediate left, I'd like to introduce Chen. She's the chief executive of ICBC in London. Next to her is Gerard Lyons, who's the former economic advisor to Boris Johnson, and also the former chief economist of Standard Chartered, which, of course, is where he gets his interest in Chinese banks. And then on your right, we have Jonathan Cornish, who is the head of Bank Ratings North Asia for Fitch. So Jim, maybe I could start with you. And I mean, we've seen this incredible growth with the Chinese banks. I mean, literally over the last sort of 10, 15 years. So they're in this very dominant position. They have the highest assets, the highest profits by country, and the highest tier one capital. Do you think it's going to carry on like that?
Well, I believe so. I understand that the banker ranked the banks mainly in terms of tier one capital.
That's right, yeah.
Which is almost every bank is keen to grow. Of course, Chinese banks is no exception. Well, I would say that as far as I know, no Chinese banks, including ICBC, has set the target that we should remain on the top of the banker for how many years. So it's a result rather than an intention. So back to the tier one capital, it is, well, in my understanding, largely driven by the profits that the bank can generate. So the more profit the bank can make, the more resource you may be able to boost your capital. Of course, the shareholders' funding is another resource, but may not be so readily available at all times. So, Brian, you are correct that at the present, Chinese banks not only on the top for tier one capital, but also on top of the profit.
I mean, one of the interesting things is they actually, as a group, they grew their capital between 7 and 11% last year, but their assets by only between 2 and 5%. So they're obviously keen to have more capital against a lesser amount of assets, which suggests that they're getting a little bit cautious. Do you think that's a fair assessment in terms of the outlook for future business in China?
Well, I didn't look at the detail of the percentage, but I do think that nowadays banks, including the banks in China, is becoming more cautious, because obviously this is not a very optimistic economic environment globally.
Yeah.
So banks tend to be more cautious and tend to have more reserves and be cautious about the expansion.
Okay.
That's true.
Jonathan Cornish, let me get a view from you. Obviously, that you're busy rating the banks. I mean, do you think? I mean, you saw the way we went through. The Americans, the Europeans, the Japanese, the globalists. I mean, in the year 2026, will the Chinese banks still have that strong position in the bankers' ranking? Do you think?
We would think so. It's interesting, though, when you did go through history, looking at the rankings, the Japanese were on top in the 1990s, subsequently had a crisis. The US were on top in the 2000s, subsequently had a crisis. We are not necessarily predicting a crisis in China, but we do think that there are some very tough challenges ahead for which they need to navigate their way through. And there are lots of opportunities for them to expand as well, primarily outside of China, where the representation of even ICBC is not as great as someone like a Bank of China, but there are very considerable opportunities to expand. One Belt, One Road would be a classic example of that. But the Chinese authorities are looking for the corporate sector to go global, and we're seeing that the Chinese banks are following them. And as a result, we think that there is a likelihood that the Chinese banks will continue to grow their balance sheets, continue to boost their profitability, and will remain quite strong relative to other institutions, at least in size. But we definitely think that there are growing risks, and that's duly reflected in the standalone risk profiles that we've assessed, which is reflected in our viability ratings.
Okay, we'll come back and talk about the sort of, the big sort of challenges and the balance sheet challenges in a few minutes. But Gerard, first of all, perhaps I could get your view on the growth outlook for China. I mean, most people are looking at about sort of 6% next year and just a bit more than this year. Is that fair, or do you think it could be higher or lower than that?
Yeah, well, the biggest challenge with China is the data itself. So the official figures suggest China is having a soft landing. There are many other suggestions that China may indeed already be having a hard landing, the collapse in commodity prices last year. But the figures in the first quarter, I think we all know, 6.7% growth. The economy looks likely to 6.5% the second quarter, but it is decelerating. I think one needs to step back and say that clearly the trend in China is up, but we should expect a lot more volatility along the way within the Chinese economy. And we're moving from a focus on growth at all costs, which was the main objective a couple of years ago when China had double-digit growth, to now a better quality of growth. But the Chinese often work backwards. Is it 2049, the 100th anniversary of the country? They want to be the biggest country in the world. 2021, the 100th anniversary of the Communist Party. They want to have much higher income standards. So basically, at the beginning of the 12th five-year plan, so in 2011, the Chinese set a target of doubling real incomes over the decades. And so to achieve that target, they know they need to achieve 6.5% growth in the next few years in their 13th five-year plan. So in some respects, they've got a vested interest or a desire to achieve that 6.5% growth figure. But the big issue, speaking to people just earlier this week about China who were over, certainly when I was over there last few months ago, is about whether the Chinese go for faster reform or a slower pace of reform. And the 13th five-year plan would suggest that China is going to continue to reform. And within that, against this backdrop, the financial sector, including the banking sector, will have to reform as well.
Okay. Jonathan, do you want to come in on that? I mean, we've certainly seen liberalisation in the financial sector, haven't we? We've seen the liberalisation of interest rates. We've seen the abolition of the loan-to-deposit cap. I think that's right. I mean, how much do you think that we now have something much closer to a Western-style market economy?
I think just picking up on Gerard's point about reform, we agree that that's the baseline expectation. But whilst the Chinese did get off to a pretty good start around 2014 and into 2015 with regards to the number of announcements in reform, both from an economic macro policy and financial reform, we've been quite disappointed actually in the more recent actions taken, which seems that growth, yes, it's being managed down in a decelerating rate, but it doesn't mean that their reliance on credit has changed. In fact, if anything, it has accelerated, which is why we revised upwards our GDP forecast for 2016. And that's just, quite frankly, not sustainable. I think to your question, Brian, with regards to financial reform, yes, last year was a watershed year in terms of announcements. So we had the loan-to-deposit cap removed. It's something that we thought shouldn't have been in place for a long time now. We've got interest rate liberalisation, and we've seen deposit insurance introduced as well. On the liberalisation of deposit rates, that is something that's not being fully implemented at the moment. Our discussions with banks is that they receive separate guidance behind the scenes with respect to where they should be pricing deposits. And also there's separate guidance on the loan-to-deposit ratio as well, which is why we haven't seen a very significant spike in the loan-to-deposit ratio and what we had originally anticipated, a lot more credit coming back onto balance sheets.
All right. So what you're saying really is that even though officially those things have been removed, there's still quite a lot. I mean, in practice, it hasn't changed very much.
In our view, that's true.
Okay. All right.
I was going to say, ahead of next year's political change, you wouldn't expect them to be taking any chances, really. They've got a major political change next year in terms of the Politburo, etc. So it's probably avoid any of the risks. So I think the underlying trend is still to have reform, but the pace of it certainly will be variable, shall we say.
Okay. So let me ask Jin Chen, I mean, from a bank's point of view, obviously being the largest bank in China, I mean, clearly any time an economy slows, well, after a period of rapid growth, you are going to get a rise in non-performing loans on the balance sheet, and they're still very low in China, aren't they? And they've ticked up slightly. But so what do you see in terms of the bank dealing with that kind of situation, or the banks dealing with that kind of situation?
Yes, as I can see that the non-performing loan has picked up recently, in recent year. That's true, not only for a single bank, but for the bank industry. But, well, as you said, we should compare that how Chinese bank perform against the other banks perform. For example, from the non-performing loan, the ratio currently, well, say as of the end of last year, Chinese banks' non-performing ratio is about 1.67%.
Yeah, it's very low. Yeah.
So by absolute number, that's comparatively lower than the Western banks. Well, I should also stress that there is another indicator that is more relevant and important, and may not be so comparable with major Western banks. That is the provision coverage. Yeah. So far, the provision coverage for many Chinese banks is around 150%, which is much higher above the other banks.
All right, and you also, in Chinese banks, you have this category of loan called special mention loans, which is sort of like a stage before you have a non-performing loan. Mm-hmm. I mean, can you explain to us exactly how that works and what purpose it's supposed to serve?
Well, apart from the non-performing loan, there was, a special mention loan, in my understanding, includes those loans overdue. For example, as far as I know, if a loan overdue for more than 90 days, it shall categorize as a non-performing loan. Yeah. It is if that is less than 90 days, so it is overdue.
I see. So it's a loan that hasn't hit that 90 days target yet. Yeah.
Yes. Yeah. So that's the that's the group of loans people shall pay more attention, including the banks, including the observers.
All right, let me get a view from Jonathan there. I mean, how serious do you think the bad asset problem is in China?
We think it's potentially quite significant. If one looks at the productivity of credit in terms of its contribution to incremental GDP on a pre- and post-2008 basis, and if you compare the experience in China versus systems where we have seen a market above long-term growth in credit, we've subsequently seen a significant deterioration in asset quality. In China's case, just looking at the productivity of credit, it's not inconceivable that the balance at the end of 2008 up until the end of 2015, that some more than half probably of that net increase in credit could be a lot more vulnerable to deterioration going forward. Now, that doesn't mean that that's all going to become NPLs. It's not at all, but clearly you've got a situation whereby in China we've got precedents. So in the late 90s, early 2000s, we also saw NPLs around about 30-odd%. That said, it was a fundamentally different looking system. I think with regards to asset quality as being reported at the moment, the relevance of it is somewhat undermined by the fact that you've still got a third of credit that resides outside of banks' loan books.
Right, okay. Yeah, we want to come on to that. Yeah.
And we're not necessarily comparing apples with apples. I think that the definitions that Jin Chen gave you are correct, but then when you look at some of the city commercial banks, which we would classify as mid-tier institutions, their balance of 90-plus day overdue loans is actually higher than their NPLs. So they're not being consistent in their classification of NPLs. it's not uncommon in China for them not to classify a loan as an NPL if they believe they're not going to incur a loss. And that might be because of collateral they have backing a loan, or that they have expectations of third-party support. Quite often that might be implicit in nature, not necessarily explicit.
Okay, let's take up, Gerard, maybe we could take up that point about a third of the credit is not in the banking sector. And we're talking really here about the shadow banking sector and these sort of wealth management products, aren't we, where banks have taken loans off the balance sheet, rolled them up and issued securities against them. I mean, how big a factor do you think that is in China's economic health?
Yeah, well, I don't think it's just China, but it's become a great growing global problem, particularly since the financial crisis and particularly since regulators have become more intrusive, shall we say. But in terms of China, because it's still at an early stage of financial market development, it's a concern. And it's seen often within the overall context of the whole debt picture within China. Collective debt in China is 250% of GDP. Corporate debt's 145% of GDP. The feeling is banks are becoming quite lax. You've mentioned NPLs, what's it, 1.4 trillion. The special mention loans, I think, are 3.2 trillion RMB. So you sometimes have people quoting troubled loans of 4.6 trillion RMB. So you've got different measures which suggest that when you even look at the official data of the stuff that's not in the shadows, there's enough area of worry if the economy takes a hit. But when you add in the shadow banking sector within the overall context of rising debt within China, it is a concern. Now, before we all panic, the reality is the economy, even though it's slowing, still has the ability to grow at a solid rate in the future. The policy room for manoeuvre in China is still quite considerable. And the Chinese, as we know this year, have eased reserve requirements, or not just this year, but in recent years. They've still got scope to cut interest rates. So all of these factors are offsetting features. But coming back to your question, it is a concern.
And in times past, I mean, the Chinese government has used asset management companies very effectively, hasn't it, when it's had a bad debt problem? Do you think it would be able to do that again, should the need arise?
Maybe I should ask our banker friend, but it's about injecting. The question about capital at the beginning is very important because it's often about injecting more capital into these banks. Yeah. But the point we have at the beginning is that on the face of the capital, that would seem Chinese banks already in a good position. So it's the resilience of its ability to withstand shock. But you're right, the AMCs and asset-backed securities have been used again recently as well.
Let's get your view, Chen. I mean, do you think those risks are as stated, or are they overstated, or are they things that the banks, in any case, are aware of and are thinking about?
Well, personally, I think Chinese banks understand much better themselves than anyone else, of course.
Than these dreadful analyst types, yes.
And I shall...
people have had enough of experts, is that right, Gerard?
I shall refer to the first point I have raised in the very beginning. The situation that now Chinese banks are facing nowadays, compared with, say, 20 years ago, when Chinese banks also seems to have some concern of NPL, is that the profitability of Chinese banks
is so much higher.
Yeah. Is so much higher. Yeah. Then the banks has more reserves to absorb any cost from the credit. For example, ICBC has written off about $10 billion non-performing loans only in last year, and it makes the most profits of all banks. So that gave a lot of reserve for any future concern if, the non-performing loan is going to be more serious. So I think that is the fundamental thing. If you compare Chinese bank nowadays with the Chinese banks in the past, and also it is something that you compare Chinese banks with other banks in the world in profits. How much reserve you have to absorb the loss? How much reserve you have, and also on capital-wide, of course, as we all know that Chinese banks are on the top. So it is I think that Chinese banks are comfortable in their in the capital, and also comfortable in the ROE, ROA. So there is no concern that, you would have the capital problem in the future.
Okay. All right, let's move on then to sort of the international strategy, especially since we've got you here, and then we'll sort of talk a little bit about London and obviously a bit about Brexit. Perhaps I could ask you that first of all. So, does the UK leaving the European Union make any difference to ICBC's operations in London?
Well, I should say that prior to the referendum, the staff at ICBC London are all aware that there wouldn't be any immediate implication to the operation of ICBC in London. Actually, maybe we are somewhat different from other international banks. Not only ICBC, I understand that almost all the Chinese banks in London, we are separate from the operation of continental Europe. So UK is a standalone operation from continental Europe. UK is not the headquarters of the Chinese banks in Europe. So there won't be any immediate change, whether Brexit does happen in the end or not on that part.
Okay, so you don't think it's going to happen?
Well, I'm not sure. I believe everyone is digesting the information, but there is a concern, I understand from many other international banks, foreign banks, that how should they locate their European headquarters if that is in London? Will that still be in London? So that is a question in the midterm, but that is not a question for Chinese banks.
Okay, Gerard, you were pro Brexit, but what about the concern? Obviously now that the city is going to lose a significant part of business if we're not in the European Union, and especially if we don't get passporting rights.
Yeah. A whole host of issues here. First and foremost, there's a perception amongst many people in the city that to have remained in was the status quo. To have remained in was a ticking time bomb for the City of London. And you only need to read the government's own competency report from 2 years ago, the 100 pages about a financial sector and what lay ahead for the UK and for the city if we remained in the European Union. So we should all have a sigh of relief in that respect, although people in the city tend by their very nature to be short-term. Yeah, it was always accepted that there were two immediate issues, Euro clearing and basically passporting. 75 banks in the EEA area passporting to London, so it's always seen as a two-way flow. If we should invoke Article 50, because that's the only way to make progress on the whole thing. That's a 2-year process. Before the end of the Article 50, MiFID II comes into effect in 2018, and that moves all the attention from passporting to equivalence. Yeah. And if you're in a third country, as Britain would then be, as long as you have regulatory equivalence, then your financial sector can trade throughout the whole EEA and EU area. So basically, regulatory equivalence is a done deal for the city. So people, I think, need to focus, obviously, on the passporting issue, but they need to recognise it against the backdrop of that big safety valve. The key thing is that the competition for London is now very much global. It's New York, it's Singapore, Hong Kong. Hence, some of the big areas of growth recently in London have been linked to the RMB market, to Islamic finance. But we should remember, since last Friday, the Chinese have actually reached out quite significantly to the UK, seeing the UK in a very positive light post-Brexit. And in terms of the areas, it's finance, IT, creative sector. And for the Chinese banks, they very much view being based here in the UK as a positive factor, aiding some of the factors you touched or asked on earlier about financial reform.
When you say they've reached out, what form has that taken then?
Well, that's going via official channels, basically. We have had.
Well, how have you got this information?
I've met the Chinese Barbara. Our British ambassador to China was in London this week, but also one only needs to speak to some of the Chinese officials over the last few days, or some of the Chinese people based here in London. I'm also vice chairman of the 48 Group Club, which deals with UK-China relations. So the point, so coming back to your question, I think the key thing is obviously we're still in that sort of immediately post-Brexit phase, but it's a very dynamic scenario. And the City of London in the past has always done well by being very pragmatic about moving on. So we need to look at things in terms of the national interest, regardless of one's initial take on whether one voted to leave or remain. But it's about positioning London globally and RMB business, and also Chinese banks. Luxembourg has always been a home, as we know, for Chinese banks, as well as London here in Western Europe.
Okay. Jonathan, let me get your views on the Chinese reaction to Brexit, because you were saying earlier, that it has been significant, and it's not just a regional event.
Yeah, well, we haven't spoken to the banks in the past week to get an idea as to how they might react to the announcement, but I would imagine it's just going to be business as usual for the time being. In terms of the implications for much of Asia, I think from a sovereign perspective down through the financial system to corporates, there's no immediate direct impact. I don't think there's a lot of concern out in the region, as I can tell. If anything, there's going to potentially be some secondary impacts, whether there's any procrastination in terms of policy, trade, investment opportunities, and that has a knock-on effect out into Asia. That's probably all that we really see. But I think that the strategy for the Chinese banks in particular is to continue to go abroad, and they will continue to invest in the various regions that they are currently invested in.
I was going to say, if you look at what the Chinese are doing in terms of their economy, it's very much a going global approach. They're buying assets, so it's asset-seeking, overseas investment, technology-seeking, as we've seen in terms of Western Europe, including the UK, brand-seeking, and also they're doing greater investment to actually bring some expertise back to China, again, as part of their 13th five-year plan. So it's not only the Chinese banks doing things that are in their own best interests, but they're also doing things to mirror the development of the Chinese economy. And that still has a very going global approach to it. And the UK is seen in a very positive light as the fifth biggest economy. And the Chinese very much see that they can do things in the UK that, certainly if we look at Europe, other countries in Western Europe have not been as receptive to inward investment from China as the UK has. So it's a very good opportunity to leverage off that still in the future.
Okay. Chen, I mean, do you agree with that? Do you think that there is something special about the UK and you can, in terms of a China relationship and things that the Chinese banks and other companies can do here that perhaps they can't do in other parts of Europe?
Well, I agree the point that Chinese are going global. So there are more international interaction with the rest of the world, particularly with Europe. Whether UK is in or out of the EU, there are plenty of opportunities for Chinese banks and for Chinese customers. As I said, there was no immediate implication on the operation. And in the midterm, we are also trying to understanding our clients for the development of their thoughts.
Because, I mean, perhaps you could tell us, I mean, what are the sort of two or three major reasons for ICBC to have a big operation in London? What are the business attractions?
Well, I think the logic for Chinese banks here is no different than other international banks for choosing London, being the international financial center of the globe. So that is the reason why all the banks are come. And another reason, particularly in recent years, is that UK has opened for Chinese banks for branch, which give a lot of difference compared with what we have in the past. So right now, London indeed is the place has most Chinese banks than any other other capitals in Europe countries.
And how important do you think London is going to be as a centre for clearing and dealing in renminbi business?
Well, so far London has accumulated good infrastructure good business environment for RMB business. Going forward, I think it is highly dependent on the market itself. The RMB is, offshore RMB business. For banks, we are serving the customers. So it is highly dependent on whether the customers has the intention to use RMB as their currency for trade, for investment, for clearing, for everything. So, as long as the market is developing, I think the banks will support them.
Okay. Ladies and gentlemen, we're really now getting into the last sort of 5 or 10 minutes now. So I'd like to invite some questions. Does anybody have a question they'd like to ask? Yeah, gentleman here. I don't know if we can get there's a microphone coming along, sir. Or otherwise you can...
Thanks. I just want to come back to this ranking.
Can you say your name and...
I'm Mazian Lasso. I'm from Chaos Business School, just here. So I'm an academic. So what I do is that I look, for example, at the ranking of banks, investment banks that are underwriting kind of initial public offerings or kind of advising companies in their takeovers, but we don't see really Chinese banks. And yet we see a number of companies from China coming to the market in London, namely the AIM, and we see also kind of an increase in takeovers. So is kind of are Chinese banks here really kind of to finance the import-export rather than to contribute more to the advisory service that investment banks are doing?
Right, okay. You okay with that?
Right, yeah. I should say that currently Chinese banks here, including, particularly most of Chinese banks here in UK, only operated for just about, we started as a subsidiary in 2003. So we are probably the longest other than Bank of China. So only, 13 years. So it's quite a short period compared with many other international banks. That explains why the activities is not so wide. Secondly, you mentioned the advisory business compared with other trade finance business. That is, according to regulation, requires separate regulatory permit from the regulators. So, Chinese banks, including ICBC in London, we are building our strengths step by step. So it's not going to be the same similar style as we do in China. Being the largest bank in the world, ICBC in China do everything, and almost the top every business area. But here, ICBC London is only a small bank. We are building our strengths, gradually, step by step.
Any more questions? Gentleman down the front here.
So Matthew Hammer with Warwick Business School.
There's a...
Cheers. Matthew Hammer with Warwick Business School. What impact, if any, do you think reform of the state enterprises will have on either the economy in China or more specifically on balance sheets in the banks?
I think we've got three Warwick University alumni here, actually. So I think Jin Chen went to Warwick.
Well, particularly...
So the Warwick Club.
Particularly, I wouldn't think too different about how the reform of SOE would have a significant impact on us. Both in China and in UK, ICBC is supporting a wide range of customers, including the state-owned companies, also including the private companies. And, for your information, most of the clients of ICBC in London is UK corporates as well as the multinational corporates, rather than Chinese corporates. Although we are also very keen to serve the Chinese customers, but we are serving a wide range of the customers.
Jonathan, do you want to come back on that? I mean, I think there's obviously an issue about the reform of state-owned enterprises in China and how quickly that will go ahead or not. I mean, do you have a view on that?
Venturing into territory that's not so much my domain, we do expect state-owned enterprise reform to continue, albeit probably not as fast as what we had anticipated. And I think that there is a general reluctance to press ahead too quickly. I think Gerard picked up on the point earlier with regards to there's no need for them to pick up the pace, especially with a very important year coming up next year. So we think that actually, if anything, things have slowed down, but we do believe that the policymakers still place a very high importance on reform. We do expect that to occur over time, probably just not as quickly as what we had originally anticipated.
Okay. Any last questions? Oh, yeah, we've got two over here. Great. Fantastic.
Hi, my name is Mike Fan. I'm from the Channel Syndicate from Lloyd's of London market. I wonder, at this time when Chinese banks are expanding, and especially for the One Belt, One Road policy, are Chinese banks, including ICBC, looking at using alternative risk management ways to manage your portfolio? Do you also?
He's trying to sell you some insurance.
No. I'm just asking because I've talked with different banks in London, the Chinese banks. Some banks are starting to look into this, but some are not. So I just wonder, is there any risk management measures that your bank is taking?
All right. Do we need to explain to everybody what the One Road, One Belt policy is? So Gerard, do you want to?
Yeah.
And then we'll ask Chen to
One
answer
Belt,
that.
One Road actually is probably the most significant economic development, apart from Brexit maybe, over the next decade actually. It's probably the biggest infrastructure boom globally. The Chinese president talked about it a few years ago. No one really knew what it meant. The One Belt, One Road effectively means rebuilding China's links with the West, recreating the old Silk Road. The belt is the road bit. The road bit is the sea bit. It's quite perverse. And the Chinese are basically going to develop overland and sea over to Western Europe. So basically, 28 cities are mentioned, 14 on the road bit, 14 on the belt bit. It will take China trade links via the road through the Stans all the way into Western Europe to Antwerp, etc., to the Channel borders. The other bit is to go down into the subcontinent, into the Middle East, and down into the east coast of Africa. To point out, like 3 years ago, when the European Union was prevaricating over Greece and whether to help Greece or not, the Chinese went in and did a deal to effectively loan Piraeus, the Greek port in Athens, for the next 35 years, because that's going to be their port on the Mediterranean bit of the road. And it's a massive infrastructure boost, which naturally needs to be funded. And the two cities that the Chinese think will be the biggest beneficiaries are Kwai in Western China and Istanbul, to put it in perspective.
Very interesting. Chen, do you want to ask this gentleman's questions about whether you need help with your risk management?
I wanted to echo that you are really knowledgeable about the One Belt, One Road. I'm not sure I myself can explain as detailed as you can. Back to the question about the risk management on the One Belt, One Road business. I can't immediately think of any so special risk management measures. As Gerard said, a lot of attention and a lot of investment shall be input in infrastructure. And on that part, Chinese enterprises or Chinese banks are very familiar and are very skillful in the infrastructure investment in China. So that is nothing so brandly new for Chinese banks if they extend their business in One Belt, One Road area or in other areas. So I don't, personally expect any substantially brand new risk management. It will depend on the project, depending on the nature of the risk.
Okay. Last question over here.
I have a question for Jonathan. So when you rate Chinese banks on the financial risk profile side, do you look at the same financial ratios as you rate other Western banks? I asked this question because just now Mr. mentioned some financial ratios for Chinese banks, like prevention coverage ratio is very key. So do you look at different financial ratios when you rate Chinese banks? Thank you.
We do look at the same ratios, but we also look at a lot more. So the position of the Chinese banks is that there is a lot more credit that's not necessarily reported on balance sheets. So I think the traditional financial ratios that one might look at in assessing a normal institution is not always applicable in the case of the Chinese. They look very well in terms of capital position, profitability, NPLs, etc. I think we take a far more forward-looking view when it comes to the financial system, and in particular, we don't look any further forward than in the case of asset quality. And the point that I mentioned earlier was that you look at the pace of credit growth in the last 7 or 8 years in China, which has been astronomical. There's been no system that I'm aware of in history that's really gone through that process that hasn't subsequently had an adjustment. And we do think that China's already going through that. So they're non-performing loans and special mention loans, etc., probably not fully representative of where they might end up over time.
Okay, ladies and gentlemen, I think we've got to leave it there. I'm going to give the bottle of champagne to you for that final question, because nobody got the ABBA and the football questions. And please, can you join in thanking the panel?